Hello, everyone, and welcome back to Moementum Finance channel. My name is Mo, and today I'm super excited to be welcoming an amazing guest, a blossomer, an investor who I've had the privilege of getting to know through Blossom to this show. Matt, welcome here.
Thanks for having me, Mo. Much appreciated.
Of course, thank you so much for accepting my invite. For those who may not know you as well, why don't you provide a quick introduction of who you are and how your investment journey began?
So my name's Matt. I started on Blossom like pretty much in the early days. I think when when I first joined, there was only about like 40 or 50,000 followers on there, and now there's hundreds of thousands, right? So I guess I was one of the early people to Blossom. I came across like your content pretty early, and it's really helped me along the way in terms of like just helping me with like just my overall investment strategy and like the way I track things. Just overall, like, it's been tremendously helpful in my journey.
Yeah, I mean, speaking of tracking, I know a few years ago when in one of my videos I was talking and I was sharing some of the snippets of like a simple tracker that I'd built. It was fed off of some sort of a Google spreadsheets, and it was in Looker Studio. You were the one who actually reached out, commented, and you were sharing some of your own trackers that you had developed, and I was super amazed as well. I know I have a few questions later down the road that I want to touch on that, but maybe quickly asking why measuring things and tracking things is important for you when it comes to whether your health, your financial circumstances, and all of that.
So just to give some context, I work as a data analyst. So
Okay.
like I work with data. So some of these trackers that I use at work are like the Microsoft products, like Power BI, like Microsoft Azure is like another one. But like in my personal life, I kind of realized that, these things that I do at work can also translate to like what I do in my own personal life. And I've kind of narrowed it down to like two areas that can like pretty easily be tracked. And that's both like my finances and like aspects of my health.
Very cool. Very cool. I know in a while we're gonna have you potentially share some of those trackers with us if you don't mind, so that at least for our audience takes a look into those aspects. I'm gonna go back to your investment journey. When did you start actually investing in the stock market, and what triggered that first switch, essentially from the traditional, like maybe savings in a bank and whatnot, to now it's actually starting putting money into stock market?
So I think we actually got started the same way, like with banks. You've mentioned before, like you were with a bank and you were in mutual funds. So
Yeah,
like
exactly.
when I got my first job, I actually started the mutual fund journey. So that was like over like 2 decades ago. So I started with mutual funds. I went into the bank and I did that concept of like pay yourself first from like Dave Chilton's like Wealthy Barber book. And I would just contribute in, and there was only one account at that time. It was just the RRSP. There was no TFSA. So I just contributed that like amount like every paycheck, and that's what I did. Where I found is like I started like looking at my statements in 2021, and I realized that like they're starting to like they were like basically underperforming the like overall market. So like that's why 2021 I became like a self-directed investor, and just partially, right? Like I still had some of the money in mutual funds. I just started out on my own with some like individual like stock picking. And then from there, I became like fully self-directed in 2023.
That's cool. And once you became self-directed, did you go there out of stock picking, or did you right off the bat started going into ETF world?
I think it's the same as you from what you've mentioned before. Like I started with stock picking because that's what I thought it was, right? Like this is before Blossom was around and I didn't really know like any other strategies. I was actually like, I would work out and watch the news, and it would basically be sitting on a bike that I had in my basement, right? And I would just be riding my bike and like watching the news and, listening to music. So like I would see the ticker at the bottom for the TSX and the New York Stock Exchange. So I would just see those tickers. And around that time, 2021, 2022, I noticed like a lot of the energy stocks were the price of oil was cheaper then. And that's how I started. It was like, oh, like it looks like there's some opportunity here. I didn't really know what I was doing, but I started, and I was kind of like lucky because that's the time that energy stocks and like say gasoline went up to around like over $2 a liter, right? So like I actually benefited from that. And it was like, I'll be honest, it was kind of lucky just from an observation while I was like exercising. And then kind of that lasted for so long. And then in 2022, there was like a downturn in the market with a lot of the tech stocks. And so like to me, those seemed like some pretty good value at the time. So then I like got into those ones. So like my first like couple years in the market went pretty well just by virtue of I think I attribute it more to luck. And like Ben Felix has talked about this on his podcast before, is where like maybe like you're just investing in the right sector. Like you're not necessarily like a great stock picker. I was not. And I just happened to stumble across like the right sectors at the right time.
And then since then, Matt, have you maintained that kind of the desire and interest in essentially picking individual stocks, or have you evolved since then? What proportion of your portfolio essentially is stock versus ETFs?
So I'm roughly around 60/40. I think like the exact numbers are it's like 58% ETFs and 42% stocks right now. This is from like 100% stocks. As each year goes by, I'm moving closer and closer to that, like, the more like the Momentum Finance type portfolio where you're just like 100% in ETFs. I was actually surprised you had a guest on recently, Mr. Financial, who was also like a stock picker. And I was kind of surprised when he announced that he's pretty much like all into XEQT right now.
Yeah, that's amazing. It's I find it, for me at least, for and I think for many people who do invest in ETFs, we essentially prefer that aspect of the simplicity. And maybe I think once we start transitioning, we see how much it makes your life easier and without having to really do a lot of like research or anything like that. It just, I think it's the advantages is well worth the probably the adrenaline rush that sometimes I think some folks get from stock picking. I'm not saying that's the only reason, but definitely there's that aspect to it too. You've been very also transparent as well on Blossom. I know you don't post a lot there, but you comment and you are active on Blossom. But I was in preparation for this interview, I was going through some of your last posts. In one of those, you had actually early on in the year, you shared your financial goals for 2025. And then as the year went by, you were updating and essentially saying, okay, yes, this goal was achieved and whatnot. Do you mind touching on that and essentially sharing with us why setting goals, especially and maybe communicating it publicly or maybe writing it down, is important for you?
So, you put out like a reading list of like, like these are some of the books that you found was helpful, right? One of those books in there was James Clear's Atomic Habits. And it's like in that book they talk about setting up like good habits, and part of like setting up good habits is having some goals, right? And some is some milestones to reach. So one of the things that I find like so helpful is like it gives me some sort of plan for the year to track and keep me in terms of those like big long-term goals. And like I'll be honest, like I think I made some mistakes like earlier in life. Like I used to track these things, and I think somebody could fall into this with investing, right? Like sometimes you see those numbers where it's like you need 1.7 million to retire, and various numbers there, but like I see all these different ones thrown out. That is a long-term goal to achieve, right? And like just to say like I just want to hit 1.7 million is like with no little check-ins along the way is I think extremely difficult. And I think too like that goal, you could lose sight of it like along the way in transition. It becomes like so overwhelming. So that's what I find, like the goal setting is like on an annual basis. It just kind of keeps me in track for those long-term goals. And I set two big goals like similar to that. Like I wanted to become like debt free, right? So I didn't want to have like a mortgage anymore. And I worked on that goal, and I had my spreadsheet and I tracked it for like 14 years, which is pretty easy to do with like fixed rate mortgages. And like you kind of like know all the numbers, you know the principal amount, much more difficult than, much easier than say like investing would be. And I found like I would fall into this goal for like 14 years, and it just, like when I spent so long on it that like when I reached it, I didn't really have anything else to transition to. Another thing was like, say for like the kids, like for my RESP accounts for them, it was like I created a forecast in terms of like I took a look at, and I think I've mentioned this to you before, basically taking a look at what the tuition costs were and like the residence costs and the meal plan costs. And then I would kind of like, this is when I first set up the accounts, before they were like 1 year old, right? I think it was like 3 or 4 months. And I would forecast those costs and kind of like get like a total amount and set that goal on the total amount. But once it was reached, it was like, what do I do now, right? Because you've been working for something like say on your mortgage or like educational savings for your kids. And like once those goals are reached, it's like, well, what do I do now? Because, like I didn't really have anything else to transition to like right away. And that's why like it took me some time to start like back in 2021, like I was saying, like, becoming like investing in the stock market because I kind of had to have something to do with the money and I didn't really plan for that. Right. So that's why like my first few like stock selections, weren't very good ones. So, and I figured that was the tuition that I paid, in terms of like, making those mistakes.
Learning from along that journey. What are, if you don't mind me asking, what are some of the goals that you have in mind as we are recording this? We are almost wrapping up the year 2025, so 2026 year is just ahead of us. What are some of those key financial goals that you've set for yourself for this new year?
For the new year? So one of the things that I like to do is like maximize like all the tax advantaged accounts, right? So I've set a goal that I want to contribute to my tax-free savings account, so my TFSA, and even to like it's time specific. So I want to have that done in January 2nd, right? So like that's this week, right? So I just have to wait for the year to turn over. And when the market opens on January 2nd, that's one of like my primary goals this year is like max out that account. I also too have a registered disability savings account, which I will gain new space at January 1st in that. So like I'll be looking to maximize that account as well as my RSP once I get my notice of assessment, probably around April. I'll be looking to maximize those three tax advantage accounts. Beyond that, because you got to think there's quite a bit of the year left, I try to set some goals like throughout the year. So one of the ones that I've maintained over the past 5 years is a 30% savings rate. And that 30% would be based off of my net income. And that would be one that I track each month, like through the dashboard that I created with Google Looker Studio. At the end of each month, I'll go in and enter my like numbers from the month and just kind of see, am I above there? And like, I'll be honest, do I hit that goal every month? No, I don't. Because like situations change, right? Like say the holidays rolls around and you have a bunch of gifts to buy. So like December could be a tough month to hit that. But going back to like the James Clear Atomic Habits books, like he's talking about like with your goals, like it's kind of like, you probably will miss once. It's like what you don't want to do is miss twice, right? So like if I ever have a month where like I do miss my savings goal, and it happened 2 months out of the 12 in 2025. And it's kind of like what went wrong there and like how can I improve it? And just make sure that it doesn't happen twice. So like 30% savings rate, the tax advantaged accounts all max. And then beyond that is I don't really do a lot of non-registered investing. And that's one of the ones that I made a priority this year. So like what I want to do is I want to set up $500 automated. And
Mm-hmm.
that's actually from another one of the books that you mentioned, Ramit Sethi's I Will
Mm-hmm.
Teach You to Be Rich. Talked about like, making like automating some of the things to make it just, to add simplicity and make things easier in your life. So like it's going to be $500 bi-weekly into a non-registered account.
That's
And then
amazing.
I think I have the final one is, and this is not, I'm about as good of a dividend investor as you are. Like we would probably both be below that like
Yeah,
2% yield.
for sure.
It just so happens some of the ETFs I invest in do have dividends. So I set a goal there to like see if I could generate $6,000 of on the year in dividend income or like passive income, which should be pretty like easy to do.
Attainable. Yeah, that's so
And
cool.
that number is kind of set that $500, I figure like when I retire eventually, like the difference between like my pension income and my like in terms of my working income, because I would no longer attribute to my like RSP, so like I wouldn't have like that contribution there. So I figure like that amount is kind of
Bridge that
like,
amount.
yeah, basically that would be the difference of me, whether I'm working or not, right?
Yeah.
The gross value would be very different, but in terms of like what it would mean to me, it would be in and around that range, just because it would be hundreds of dollars a month that I would no longer be contributing to my RSP.
And Matt, would you be essentially once you decide to kind of retire, would it be like categorized as like a traditional retirement, or would it be in your mind? Would it be categorized as like you've actually planned ahead of things ahead of time, and essentially you're um, getting out of the traditional workforce earlier on?
So that's actually like a really good question, right? So part of the reason why I have the registered disability savings plan is I have type 1 diabetes. And when I originally like started looking into it, looking at like journal articles and papers, I noticed that like some of them had like the lifespan of somebody with my condition would be kind of like 10 to 12 years less. I think that has kind of like changed over time because there's better technologies. Like I wear like a glucose monitor on my arm that kind of like gives me constant feedback of like how I'm doing. Like I manage my diabetes quite well. But like when I originally saw that, it was like, okay, like maybe I want to speed things up where like I retire in my early 50s versus like the traditional like 65. Just because like I feel if I'm going to lose some years off the back end, which may not necessarily happen, but there's a probability, like a higher probability than say like another person, perhaps I should like be looking at stepping away a little bit earlier.
Yeah. No, I think that's smart. And obviously explaining that at the onset that you are a data person, data analyst person, and that's what you do. Like I can see different aspects of it now shine throughout your life as well. Tell us, if you don't mind, a little bit more about our DSPs. I don't know if the type of account that is as well known, obviously because you have had that account yourself, based on your knowledge of what you're familiar with. Can you share a little bit more about who might be eligible for that potentially, and what are some of the advantages of an account opening it if one is eligible for it versus not?
So this is account I kind of feel that is like one of the most like underutilized ones and one that's never really talked about. Like I recently read the update to Dave Chilton's Wealthy Barber, and he actually mentioned it. I think it was in his final chapter, which I thought was pretty good. But it's one of these accounts where like it doesn't take a lot of money, but like the matching is so it can be between like 100 and 300%, right? So you know when you contribute to your you contribute a certain amount, and then you get, I think it's like a 15 or 20% match.
20%, I think, yeah.
Yeah, 20% match on that account. Whereas this one here can be between like 100 to 300%, like based on your income. It can't take as much money, but like so for some people, you can put $1,000 a year in it, and potentially you would get a grant that would be between like $1,000 and $3,000 depending on your income. In order to qualify for it, you have to have the disability tax credit, which also too has some benefits in your tax situation. And generally, like it's for like people with like the definition would be like severe and prolonged impairments. So and how they kind of define that when I was reading through the website, like to seeing if I qualify, is like you would have to have some condition which would take like you'd be spending 14 hours a week or more managing. So like the criteria to get it is quite high, but it just so happens like what I have, like I qualify for it. And I find actually to be like one of the first things I do. That's why like January 2nd, because I can't, the banks and the markets are closed on January 1st. So when January 2nd rolls around, I probably will be putting money into there. That's actually one of the areas in my portfolio where I don't have like stocks or ETFs. There's only two banks, like two institutions that offer that account to my knowledge. So it's like
Mm-hmm.
TD Bank and National Bank. And like I don't bank with either of them. So it's like, and I also too, like I do have my traditional like big six bank as well as like Wealthsimple with
Mm-hmm.
like the majority of my portfolio. So that's like one of the areas I still do have mutual funds for, just because like I don't really have an option for a self-directed account unless I want to change institutions. To be quite honest, I'm patiently waiting for Wealthsimple to bring it over. Each year they kind of have a annual like meeting where they discuss all the things they're launching for the year.
Mm-hmm.
So every year I'm on there like asking the
Hmm.
question, when are you going to
Well, that's
launch this? So like I'm really hoping they do
they
that
do.
soon. So
Yeah.
I am waiting patiently. But in the mutual funds that I use, they're pretty much just index funds with the lowest MERS possible. So like say for yourself, you have the like management expense ratio of, I think it's like 0.2%, so 20
Yeah.
basis
Exactly.
points. In these ones, they're about 1%. So they're not
Mm-hmm.
your traditional like 2 to 3% mutual funds. They're just index funds. So I am paying probably like 5 times the amount, but I figure that the grant there, like, because it's got like 100% match, it just makes it like for simplicity reason, I just stay with like the bank that I'm with and manage that account.
And why do you think folks like may not know as much about RDSP or take advantage of it, even if they might be eligible for it? Is it lack of knowledge or any other reason?
To be quite honest, it took me like a few years to discover this account. Like it's just one of these things that there's, we don't really talk about it on Blossom. It comes up like the odd time. I was actually really surprised to see it in Dave Chilton's Wealthy Barber book. It's just one of these ones that I don't think there's a lot of awareness with it, but like just think about like, having an employer match with work on your RSP, or like say like some of the grants that you get through the RESP. This is pretty much like that, right? Especially too for some people, it could be up to like a 300% match. So like that's why like that would be like the
Huge.
first thing I do on the year, right? Just like if I had an employer match, as well as like, in my RSP as well as like TFSA space, I would probably do the RSP matching first, just because, like, especially too, if it was like 1-for-1 matching, like that's where I would go to first to take advantage of that. And then I would probably move to my TF.
It seems like for you, Matt, health and wealth and finances are definitely two important aspects of your life planning. How do you try to emulate and essentially pass on this important knowledge and awareness to your kids?
So this is one of the areas where you've definitely had some impact. When I was looking at your like just this the simple like the simplification of your portfolio with like the vast majority being in XEQT, um, I took a look as like when they turned 18, I was like, this is a good opportunity for them to start their portfolio, right? And I think at this stage of my life, I don't know if you ever watched the Money Guy podcast where they talk about the wealth multiplier, right? So time being such an important aspect of that equation, right? So they kind of take a look at people at a certain age. So I guess we're probably similar in age. I think we're about like, maybe 5 years apart or something like
Yeah,
that.
I'm in my early 40s. Yeah.
Yeah, and I'm in my mid 40s.
Yeah.
So like um so for us like that wealth multiplier, because like we don't have as much time and say to the traditional retirement age of like 65, like they consider like a wealth multiplier of maybe like a factor of 3 there, right? Whereas like for say somebody who's like 20 years old, that wealth multiplier could be like 80, right? So like $1,000 invested to them could be like $80,000 to their future self. And that's not like, with 30% market returns or anything. That's just assuming like average market returns. That time component is so helpful. And that's one of the things that, like I feel like I missed out on when I was younger. We didn't have the same accounts. Like there was no tax-free savings account. When I originally started working. But for them, I find that that's exactly where I want them to be. And then also too, just with a portfolio, instead of focusing on like stock picking and complicating their life, just like, the habit of, investing in their tax advantage accounts like every single year. And for them, that's pretty much the TFSA, just because like with RSP, you might have some income as a student, but like I just don't, that would probably be more beneficial like once they start working, as well as the FHSA, because that's kind of like money that's specific for certain things, whereas the TFSA can be used for like anything. So, yeah, getting them started early, I think, is the most important thing. And like also to just that regular habit of like we want to aim to maximize like our tax advantage accounts, each year.
Super powerful, right? We definitely want to take advantage of that. And that's why I love how you're very concretely bringing it and mentioning it as part of your financial goal settings for the year. And you're very deliberate about it too early on, trying to essentially very optimized around the timing of it. Like with RRSP, as soon as essentially you have the notice of assessment and you know how much room you have, trying to shortly after take advantage of that. With TFSA, January 2nd. The RDSP, similar story. That's super powerful. Reflecting back on your own journey, Matt, is there perhaps one lesson that you've learned that stuck the most with you that perhaps, reflecting back, if you were to share with others, you want to bring that to your forefront of their attention?
So in terms of what I do with like I guess like investments in my portfolio as well as in my health, I think like the biggest thing for me is staying consistent. So like each year, each month, each day, just trying to do those like little things, like similar to like the concepts that James Clear like mentioned in Atomic Habits, right? It's doing those little things over the short term that have such a profound effect over the long term, right? Especially too when it comes to investing, that compounding is so easy to kind of see. Like when you see the charts just go like, parabolic up and to the right. Um, if you use a long-term like compounding interest calculator, that's exactly what you see, right? And it's hard to see that in the early stages when like you're not, really getting that. It's one of those things you just have to stay consistent, and with that consistency will lead to those like tremendous results in the long term. And I think like easier to see with investing. Health is one of those things where like I've recommended this book to you. It's Outlive by Dr. Peter Attia, and it talks about kind of the idea of like lifespan and health span, and kind of like ideally like I want to do these like daily things in order to like live the healthiest life as possible, so I can have like the longest like health span, right? So like say on my final day, like I'm still was relatively healthy for the vast majority like of my life, as opposed to spending like, 5 or 10 years where like I don't get to enjoy the things that I want to do.
Matt, how do you balance that, uh, essentially the notion of enjoying your life, living in the moment, as well as like, uh, celebrating the things that matter to you, doing the activities that excite you right now, while at the same time, uh, not jeopardizing your ability to save and invest for your future? How do you go about balancing that?
So I find like somebody mentioned this in a post the other day on Blossom. That's why like I see so much great content there. And it was actually from to another book. I believe it was from Morgan Housel's book, The Art of
Psychology of money?
Spending, right? So like
Oh, there
I
you
think
go.
the psychology of money was in like you had that picture of the books
Yeah.
that you recommended. And so Morgan Housel, that author's had another one, and he talks about like wealth and like in the context of happiness being related to the things you have, less the things that you want, right? So like I find to achieve that like balance is, I don't like say, the holidays came up and people ask me like, what do you want for Christmas? I'll be honest, I can't say anything just because like I don't really want anything. Like in terms of like I'm happy with the stuff that I have. I like what's important to me is like my daily routine. So even if I am, say, traveling with like family or friends, like I generally pick like a hotel or that would have a gym because like that's part of my regular routine and that's important to me. So, and that's the things that I like to do. And even too, like while I'm working out, which would be probably between like 5 and 6 hours a week, that's where like I don't listen to music anymore. That's where I listen to like financial podcasts, right? So like I'll listen to the Canadian Investor podcast. That will get me through like roughly 2 hours of workouts on the week. I'll listen to like your YouTube channel. One of the things I wanted to ask you is, how that you put this out on YouTube is like your primary platform. Have you ever thought about putting the audio out on Spotify?
Yeah, it's a great question. I can't remember who was asking me that the other day. Honestly, I think that's a great idea. Like, and I believe these days, to be honest with you, a lot of people, we being a lot of busy people, like one probably listening to the concept. I think in YouTube you could, as long as you're a premium member, so you don't have to like really have to necessarily put on the video and whatnot. That's a great suggestion. Do you think that that would probably make the content much more consumable? Is that what you were going with this?
You would just pick up all the people on the audio side of it, right? And
Yeah,
then for anybody with Spotify Premium, like they would just listen consistently without ads, right? So like I do find I do like consuming the content on
yeah.
YouTube,
Audio
but
form.
sometimes like I am, like you just need the audio. You're going for a walk or you're going for a run and you just want to consume some content. Like YouTube, you actually have to have your phone open, right? Whereas this, I
Yeah,
could just actually without
in
like
the
YouTube
background.
Premium.
Yeah.
Yeah, whereas this I could actually just consume the content. And I think you would pick up like a whole additional um followers like just by that, putting it out on more platforms.
Yeah, to your point. It's funny that you mentioned that. I was listening to Rational Reminder. I think the most recently they had this episode. Was it a few days ago? I was listening. They were reflecting on their last year and essentially the content and whatnot. They were talking about like, several years ago, of course, they introduced their content as well on YouTube. They were saying proportionally YouTube has picked up more like audience for them proportionally, like in terms of growth. But of course, I think it's still around 60% or plus of their audience is on Spotify. And they were talking about like now how different platforms have evolved too, like so much so that even on Spotify you could essentially even post video content. Like, I mean, came across it and never used it, but I guess to me, one of the challenges that always I think about is that the time it takes, Matt. And maybe it's one of those things that I need to do a little bit more digging into it. If there is maybe solutions out there that whereby when you're uploading the content once, maybe at the same time it feeds into multiple platforms. Because to me, that is really honestly the main barrier. Because if the content is there, it's not, as long as there's an easy way to funnel it to multiple content platforms, that would of course be easier thing to do. That's just the time is so challenging. But if you have ideas and solutions, do let me know. Hit me up for sure with that.
Well, that's what like exactly the Rational Reminder podcast, like I listen to them every week just by virtue of like that takes care of like another hour that I'm like say working
Yeah.
out. That gets me through like another one of those hours, right? So like I guess like to some people, like I know when I was leaving, you're saying that the difficulty in maintaining that like balance, whereas like I actually find it enjoyable, right? Like it's actually like I'm pairing like like that activity of like exercise was something that I like to do, right? So like I find like those investment podcasts, like I find them entertaining, I find them interesting, like I'm learning something, and I'm pairing that with some sort of activity which is also like beneficial to me.
The stacking
So
part, right? That reminds me
yeah,
of the Atomic Habits, right? You
Atomic
stacking.
Habits, exactly.
Yeah. Yeah.
So, and it's not to say like I don't enjoy exercising. I actually do enjoy it, but now I'm like, yeah, kind of having those like two things that I like to do, and it makes it even more enjoyable for me.
Yeah.
So, like each day when I get up, I'm actually looking forward to it. This is how I track my budget. I have like 5 years of data in there now. So I have from 2021 to 2025. For trending purposes, I find like getting like 3 to 5 years. So like when this started out and I only have like a few months of data in there, it wasn't quite as helpful, right? But like now that like I have some patterns established, I can kind of see like in terms of my expenses like each year, like how they're changing each year. And then also too, like you can even focus in on specific like the year over year costs, right? So like one of the ones that I remember was you remember we were talking about earlier when I got into investing in 2021, 2022, and like the gas prices were up. One things I picked up on that in my actual dashboard, right? So like all this stuff breaks down by sorry, that one was in housing,
Like by
natural
year as
gas.
well, right?
And you can kind of see like in the
Mm-hmm.
bottom section here, you can kind of see like my expenses over 20 from 2021 to 2022. I remember calculating it was like up like 55%, right? So I was like, oh, that's quite the raise in my annual bill. Like, like usually, like, you read the inflation report and you kind of see those like, 2, 3, like, in some years they were bad, they were closer to 7%. But like when something raises 55%, that's like, that's very extreme, right? So that was one of the ones where when you take a look around and it's like, well, say like an insurance provider, can I switch to somebody else? And like, there's many insurance providers. Natural gas is one of the things that you can't do that with. So it's like there's only one provider for the neighborhood. Like I don't have an option to move somewhere else. So that's one of the ones how I started investing in Enbridge. Just because I kind of felt like, they had like that higher dividend ratio, and not that this is a good reason for investing, but it was like basically the amount that my bill went up there, which you can see is roughly about $600. Um, that was the amount in like dividend income I was getting back for the year. So it was kind of like in a way, I just like you raised my bill 55%, but now I'm going to participate in this and I'm just going to break even. And that was kind of like some of my thoughts in the early days and like something that came out of having a dashboard like this. Like another one would be recently too, like we were talking about like insurance, right? So like home insurance. This year here, so my dashboard breaks down into, I can do it based on particular years, right? So if I want to focus on like 2025 and I want to like narrow in on those costs,
Oh,
now
very
I can
cool.
see kind of like, the monthly, right? So I was, like my insurance costs went up. You can see from like July to August, you can see there's a jump there. And like, they were raising my costs. And this also had to do with my auto as well. You can see that large spike of like $271 where like that was when like I had to like pay like in order to get out of a contract. And you can see
Mm.
now or to end the policy early. And then now you can see I'm down there with lower. So I did something in order to bring down my insurance costs just by virtue of like I have 4 people on my insurance policy, like myself, my wife, and like my 2 kids. And for when I believe it like your daughter when she gets older, right? Like these are all these things that just get added
Bundling,
on. Like
yeah.
like they eventually start driving, which is great. But
Yeah.
then like there's also too the additional insurance costs. So it's like one of those things to control, right? So
Mm-hmm.
it's like, okay, like how can I get like those down, right? And these are the ones that you can negotiate. And just like, like for Meet Seti's book, he talked
Yeah.
about like, just getting some of these like like, are you really interested in how much you pay for insurance? And if your insurance is going up over like, the typical like inflation rate, could you actually keep it in line with the inflation rate if you change to like a different provider?
Did you
Um,
consider, Matt, ever like, paying the insurance cost on an annual basis, or no, that's not something you consider doing it? For us, we do that because two reasons. One, take advantage of that credit card, like, whatever, like rewards, a little bit of that is. And I mean, if my head, at least then when I pay it once and I don't have to worry about it every month. But I'm just curious, have you looked into it from that lens, or that was not something you considered?
Never thought about that until you mentioned it.
Yeah.
I did look at it because there is a small fee of like 1% or something like that if like you pay monthly. And it's just like, it didn't really seem like that. Like it was doing it for, it would have saved me like 30 or $40
Yeah,
on the
not
year.
huge.
So it wasn't really like a huge savings there, but like to your, and like mine is automated too as well, where they just like automatically withdraw it, like each month. Um, but yeah, that is like a good idea. I never thought it from like that angle where you just kind of like pay it and you're done and you move on. And then I didn't think about the credit card points. So that's why like I find like, this is what makes Blossom helpful, right? Because like you get into these discussions and you hear what people are doing and like, like I guess in your scenario, especially too if you have like I think it's like the Wealth Simple credit card where it's like
Yeah.
2% of
2%.
expenses or
Yeah.
something.
Yeah. Yeah.
Something like that could actually like, start paying off, like especially if you put it on the on
Right.
I'll go over like one more is
Yeah.
just for the this one is rolls up. I'll do kind of like this is the savings rate, right? So you can see there I have like the annual like savings target at like 30%. So I draw that line in the sand. And you would think looking at that, it's like, oh Matt, like you achieve your goal every year, right? On an annual basis, yes, right? If I were to drill that down on a quarterly basis, I think we can still say yes,
It's pretty
except for
young.
maybe this one quarter here, right? So like over the course of 5 years, I missed on one quarter, it looks like. But would you drill this down monthly? You can kind of see I have all different types of fluctuations. This one here, it's always interesting to take a look at like what happened in these like lowest points. So like that point where I dipped under, and I think my savings rate was 8.6%. So that's when this was like the first year I've had consistent income for over like 22 years. This was the first month um like I graduated from school on a Friday and started working on the Monday. So like and I've just been like with the same company ever since. I actually have a teaching degree that
Huh.
I never ended up
Oh,
using
no way.
because I actually do keep it current still.
Yeah.
It was one of those things where I needed to pay my rent over the summer. So you graduate in June, I need to pay my rent over the summer, and the teaching jobs don't start until September. So it was like, how am I going to actually like get by? So that's how I started at the company that I work with now, and I've been there ever since.
Oh,
But
wow.
this past summer, or like in May, June, they went like there was a strike at my company, and
No
like
way.
basically my income got like not even cut in half. It was like with the strike pay, it was like to a third. But you could see like I was actually like pretty resilient there. Like it's a terrible month, like in terms of like if I were to break it down, just
Yeah.
taking a
Yeah.
look at the year.
Yeah.
So that's just taking a look at all 12 months. I have my like December expenses in there now, but those could change. But you could see that was like the one month where like I, dipped under my like 30% target, but I was actually like pretty thankful that I was still able to save something. And that's the importance of having like, like an emergency fund, like one of these concepts that's often talked about. I never got to use it, for over 20 years, but like, when I needed it, it was there. Um, I didn't even actually really get to dip into it too much. I don't think I dipped into it at all. It was just there in case it went longer because as you can see, like if I had to dip into it, I would have had a negative number there. So like I was still able to, like meet my expenses. Keep in mind, like I don't have like, those two biggest line items, which you don't see in mine is um, like mortgage and like car, right? So like, I don't have like a mortgage and I don't have like a car payment. So like that kind of frees up a lot of extra money like on a monthly basis because those
So
are
you got to
usually
that
the
debt free, right? You became debt
yeah.
free as you set your goal for.
And that was actually a 2025 goal. It was
Oh,
like
amazing.
consuming some of your content was you look at like simplification, managing those like tax advantage counts. And then the other one is this, like for me, I wanted to remove all liabilities. I didn't have any like housing costs or like mortgage costs. But like once I like paid off my mortgage, like there was actually like a good promotion when I was like, oh, like I'll just go get a new car, right? And then at the end of that lease, I was like, I think it just makes sense to buy it. Just the way that cars went up in price. I wanted to kind of remove that like liability from my balance sheet. I don't drive anything like fancy, but it was like just one less thing that I could have on there. So like I removed that expense like from my balance sheet. And then like I mentioned, like outside of like June, which was like pretty rough when my work was on strike, um, it was also to December, and that generally is high. But as you can see here, I try not to miss like 2 months in a row. So like, even though it was like I just crossed the line in July, like I was able to I was able to stay above that like 30% mark.
I'm sure there are folks that are gonna look at this dashboard and gonna be super interested. So like want to know a little bit more behind the scene. Is it connected to a spreadsheet and that's how you track it? That's the first question. And the second one is, is it more of a lag in the sense that at the end of the month, once you put the number, you crunch the numbers, like, oh yeah, good, we went 30%, or no? Or do you have mechanisms that throughout the months, like you're trying to make sure you hit that 30%?
So, in terms of your first question, it's on a like a Google Sheet. So so basically, I do have an app in my phone. It's the Every Dollar app, so the Dave Ramsey app. I don't think like it doesn't matter which app you use, or like there's other ones out there. This is the one I've been using this one since 2018. A coworker like at work, like I saw that they were doing it, and I was like, that's a really good idea. So the mechanism is kind of like within the budget. It actually kind of has, it's kind of like an older concept of as like if we went back to cash, it's like the envelope system, right?
Yeah, the
Where like you
bucketing kind of
basically
thing.
just have like a certain bucket
Yeah.
for each. So like I have a bucket set up. So each month, like that bucket that's going to be attributed to savings and investing is just above that like 30%. Life can happen and like, you can take on some additional expenses, say like, you had to do like a car repair or something like that. Like those things like will happen that can impact your budget, and you can choose like, do I go to an emergency fund or do I dip under that like 30% savings target? So yeah, those are like that every dollar tool as I found pretty helpful, or just like the activity of budgeting. And I think I listened to Dave Chilton's podcast. I think it's actually called The Wealthy Barber, the same as his book. And he kind of mentions the importance of like keeping that monthly budget, like in terms of just to like set yourself up for success, so you can kind of see where like everything is going. And I would be one of those people that like I do this like every single month.
And then the notion of the pay yourself first, does that help in the sense that, let's say at the beginning of the month, you already have like as much as possible, like, because you did, I think on the onset of the call before we hit the record, we were talking about like lump sum versus DCA. Is that, do you mind touching on that a little bit just for our audience?
So these are one of the debates that comes up. And so this is another thing where I find like Blossom really helpful, right? Is because like I was that typical person of like paying yourself first. And with that is like, you pay yourself like every paycheck, like whether it be a certain amount or a certain percentage. I actually prefer the percentage because it scales like depending on your life situation and as your income changes. Um, but I also saw like a paper, like Ben Felix on one of his podcasts mentioned like a paper that was going over like lump sum versus dollar cost averaging, and he was kind of saying that I try to like put myself in a position where like you have like the best probable outcome for success. It doesn't mean that like you will be successful every time. It's just you put the probabilities in your favor, right? And in that paper that he cited, yeah, I remember it being something like 60% of the time lump sum investing uh, kind of beats or is more optimal than the dollar cost averaging. So that's why I've recently switched to the lump sum method. And I was actually just curious, Mo, what you do, because I did see a post from you once that you were doing a an automated daily buy, which I thought was great. And I was like, oh, that's like pretty cool. And I was just wondering if you still do that automated daily buy or if you've like switched over to something else.
Yeah, at the time that I was doing it on automated daily buy, it was really, I would say, a combination of wanting to take advantage of the dollar cost averaging, but more importantly, at the time, like when folks were asking me, was around building that daily habits, reflecting back on it, and seeing that every day, no matter what the market does, no matter how the world around us like evolves, I'm doing something intentional, investing for my future. So that psychological aspect of it is very, very positive. Since then, though, definitely evolve. So I don't do on a daily buy. And main reason I would say for that is that because a lot of our investments these days goes to non-registered account, because we are fortunate enough that similar to you, Matt, early on in the year we tried to prioritize taking advantage of those tax advantage accounts like TFSA and
Mm.
RSP whenever the time comes by. The rest of it, if I buy it on an everyday basis, it might not necessarily, but it might potentially complicate a little bit of that calculation of like what is the average cost base for the holdings and whatnot. And it was essentially not as materialistic, perhaps because like the portfolio size has grown so much. So
Mhm.
right now, similar to you, it's more like okay, maybe every other paycheck or when whatnot, when we get paid, we're gonna put in like maybe a set amount. And a good conversation earlier on, I think you triggered some thought for me. So potentially this year, I would definitely take into account from the lens of percentage. And with my wife going back actually to work after her mat leave starting January, I think that's gonna start things a little bit more organized from a lens of income levels coming in, because for all this past 1.5 years or so, we were on one income, so it made things a little more trickier in that regards.
That's where like that, like you're saying, like the amount, like if you kind of use a set amount, like it definitely changes when the income
Yeah,
situation
that's
changes,
true.
right? So that's why like I kind of feel like a percentage is, like I guess, I've talked about today, like I guess I've made a lot of mistakes over the years. And like I guess too, they're not the worst mistakes to make using like an amount versus a percentage. So like at least you're still like investing. But like yeah, no, the percentage definitely does like scale a lot better.
Gives you a good picture. I love your visuals, by the way. I think you've done a fantastic job. I might definitely get some inspiration from yours and try to brush off some of my past experience of using the Looker Studio. I really am intrigued by what you've done. So I might run something by you as well, Dan and Matt here, and get some of your perspectives.
Problem. And like I said, I think I've mentioned you before, like this took about an hour or two to set up.
It's
I
amazing.
think I created it probably in like when I first saw like you had one, I was like, oh, let me try like loading my budget data today. It was maybe an hour or two, like I think, and like I don't think I've updated it much except for this like percent by category when I set the 30% savings goal target. And like again, that would have maybe been like 30 minutes. Like it wasn't a huge time investment, right? And like each month when I update it, like when I update the Google spreadsheet, like I don't even know if it would take me 5 minutes, like in
That's so
terms of,
cool.
and I find like the exercise is actually helpful because like I probably spend more time kind of like, oh, how much should I spend in each category versus like, just like loading the data and then, like just these tools you don't even need to refresh. As soon as you update the Google spreadsheet, it just automatically refreshes the tool.
That's amazing. That's super fantastic. Are you comfortable, if not at least on sharing the screen, even at least speaking to it? Because I know health is also another important aspect of it. For me, when I'm thinking about like aspects of health and measuring, like obviously I have my Fitbit, older one, but still does the trick. It keeps track of like certain aspects of it, like how much I sleep, different data points around, for example, how much I walk. Most recently started to like trying to manually input how much like water intake I have. I'm curious as well, like what are some of those aspects that you would recommend perhaps from measuring aspects of health for someone?
So, well, what you're seeing on the screen right now is some of the things that I measure, and like, yeah, from it sounds like you have the tools to do it. So, like, I with this one here is kind of like I just track. I have a fitness tracker. I used Fitbit for probably close to 15 years, and I've recently switched to Apple Watch, just by virtue of I find like some of the heart rate measures like capture like with a higher degree of accuracy, as well as like it integrates with that glucose monitor that I use to for my like diabetes. It integrates with that device a little bit better. But like as you can see here, like it's me doing the same type of thing I do with my investments, but it's just like I figure like that daily steps, right? So like as you can see. in 2021, I was taking, 12,800 steps
That's
a day.
incredible.
And like I moved it up to 17,700. So that kind of would just depend on like how much I'm running each week would probably kind of make a difference in there. Like if I've been focusing on more like strength training this year, so you can see
Mm.
like my step count is down, but it's still like over those
It's
that
incredible, I tell you.
15,000. And even too, like, I will do this on like an annual basis and similar to those other graphs where you can
Yeah,
kind of like,
very cool.
break it down and kind of see like how I did like just over the course of the year, right? So like you can see as there is seasonality to it. So as you can see with some of the colder weather, like I may not be like walking as much. Whereas in the summer, like, in the warmer months, like you might be out and be a little bit more active.
The
So
level of
like
granularity, Matt, that this goes for, is it by months? Is that the lowest level typically?
those level, and then basically the dailies and the weeklies would be within like the individual app
Makes
themselves, right?
sense.
So like I
Because,
do have,
yeah, yeah,
so
that
it
makes
does,
sense.
like Fitbit and Apple both do like a pretty good job. Where they kind of fall off is like Fitbit tracks a certain set of measures, Apple tracks a certain set of measures. But if you want to look at them all at the same time, so like as you can see here, like I'm capturing my like average daily steps, I'm capturing like the calories and my body weight, I'm capturing the like the type of macronutrient that I consume. So
Very
like
cool.
I have a goal of like I want to eat. So like I had just like I have financial goals, I have fitness goals, and one of them is to eat at least 100, like an average of 180 grams of protein a day. So like I just kind of make sure that I go in and that I am kind of like staying on track with those sort of things. I have a blood pressure monitor, which is outside of like Apple or Fitbit, and I measure my like blood pressure. I measure like my resting heart rate and heart rate variability, all these different things. Sleep is
Very
another
cool.
thing, right? So like I can kind of see, and lately like this is one of the goals. You can see sleep. I kind of in and around that like 6.5 hours, and like I couldn't move the needle on that one for the longest time. And like more recently, like I've one of those books that I mentioned, Outlive, they talk, there's a section in there on sleep, right? So it's a lot of that book has to do with like setting yourself up in some of these healthy practices that like, would give you those best probable outcomes. So like it's, exercise routine, it's nutrition, it's sleep is another one. And another big part of it is like, relationships and like mental health. But with that one, I had a hard time moving, like getting beyond that like 7 hours of sleep. And like more recently, I actually have been getting there. Like I've been starting a routine where like, like I generally read for like 30 minutes to 45 minutes before I go to bed. I find it just like calms me down. And I keep the same schedule like every single day. So I get up, even on the weekend, even if I'm off, I will like keep the same type of schedule.
What was the motivation for health aspect? Was it your diabetes that made it super important for you, or no? Regardless, like I'm curious as well because the reason I asked this, Matt, is that sometimes for folks, like especially when we are still early on and young, we might focus on go, 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 work, 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 or money, 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 and then maybe later in life realize that, oh, all of that was at the sacrifice of health. And it's super inspiring to obviously seeing you're still very young, and obviously you're very deliberate about this. Like, you've thought about it, the fact that you've built it as a healthy habit of daily exercises, watching your diet, like your sleep and all of that. Any thought that you can share with others, hopefully to trigger that importance for them?
So, like, this is not something that I like force myself to do, right? This is something that I generally do enjoy. So, like, I've been doing this since I was probably 15 years old. So like this is like we're going on like over 30 years of this, right? And like I've kind of like changed over the years. Like obviously when I was 15, these tools didn't exist. And like if I wanted to graph this stuff, I'm sure you might be able to go back to like, your days in like grade 9 math where you were tracking stuff on graph paper. So like if I wanted to do it back then, it was like prior to those like tools even existing. I don't even know if I had a laptop back then.
Yeah,
So,
probably not.
but I find like I've been doing this for so long, it's just part of my routine, and like I generally do enjoy it. And like you don't have to do this stuff, right? Like I remember one time you mentioned to me when you've had some posts like related to like health, right? I think it came up in the book Bill Perkins, like Die with Zero.
Yeah,
And I think he
yeah.
talks about like a three-legged stool or something like that, where he's talking about like time, health, and money, right? So like getting the balance between them. And you said like that, I asked you, like what you were doing for like exercise, and you mentioned that, you were, going to the community center and swimming. And I was like, oh, that's great. Do I go to the community center and swim? No, I do not. But I still think it's a tremendous activity, right? It's like whatever like you do or enjoy. Like Ben Felix, like when I listen to his podcast, like, sometimes he talks about like, he plays basketball like a certain number of times a week, and that's like really important to him. And I think that's fantastic too, right? But I definitely think it's about putting these activities in your life that you enjoy. Like the reason why like I take so many steps is, actually another, thing I could point out is the jump from like 2021 to 2022 in terms of the steps, like an additional like 3,000 steps there, is I got a dog. And like, like taking, and I have a dog that like spends like an hour to 2 hours like walking outside per day. So she generally walks about like 6 to 8 kilometers per day
Oh,
in
wow.
total, right? Like over multiple walks. So that kind of like, is something that like I enjoy, right? So like, just walking the dog. And that's part of the reason why like I get out so often, is because, like I have to go walk my dog, and I generally do enjoy that.
That's amazing. It's amazing how essentially our life decisions, life choices actually have a impact in terms of our like different aspects of our life, right? Funny enough, I know before we hit the record, we were also talking about like how even personal finance can be personal. We talk about like some for some folks as they are working in throughout the years, like for that ultimate destination they want to get to, like once they retire, for them, they might be talking about, oh, I want to go travel here, see the world, or I want to go lay on a beach or whatnot. And you and I, we were talking, you were mentioning that, how it might be different for you as well. Maybe that would be a nice segue for my next question. And thanks for sharing these dashboards with us, by the way, here. When you reflect on that, like, a few years down the road that you get to the level of like, retirement or being able to essentially have financial independence, let's just call it that way. What are some of the things that you're most excited about? Are there things that are very different from what you're doing right now, or is it going to be a continuation of what you're already doing?
So I think it's gonna, a lot by and large, be like a continuation of what I already do, right? Like I'm gonna continue to read. Like I want to continue to work out. Like I want to continue to invest. So like all those things I'm doing now, but it does actually free up like 8 hours a day where I could be doing something else, right? So one thing about me is similar to like, Levi, who you had on
Yeah.
recently. I found his story pretty inspiring because he had, similar to myself, he has a health science degree, and, so he's a physiotherapist, and he just like went and got his like his
He's
CFP.
pursuing CFP.
And I kind of like look at like, maybe that's something that I would, like want to do, right? And not necessarily to start a business. It would just be out of interest. Like I went through high school taking all those like health science and math, like, or like science and math electives, and didn't really, I never took a business course, right? So like back when I went to school, you had to have like one credit of business, but, back then, computers like in typing wasn't the most like common thing. So I got my business credit through keyboarding. So I took like one credit of keyboarding, and that kind of like satisfied, but I never took economics. Like I never took accounting. Like I never took those courses. Although I took like quite a few math courses, and I'd be one of those people, how they say they don't teach like about investing in high school. I feel like I actually did learn about it because like I clearly remember like multiple like, years where we discussed compound interest, and that's kind of like something that stood out to me. What didn't make it real for me is at the time I didn't really have any money to invest, like whether it would be like paper route money or like money that like, I would make from like a part-time job. Generally, like all that money went to, I just ended up spending it on school. But yeah, no, like I do remember the, compound interest discussions in high school, and like those ones, like always stood out to me. Just that extreme growth.
How do you balance the amount of time that it takes you for entering some of those trackers? Like, is it something that takes you hours upon hours, or is it like maybe yeah, you have a routine of like maybe okay, I'm blocking the time, I go through it. I won't be shocked and surprised here if actually Matt, some folks actually may be interested. It's like, hey, can I get a copy of that dashboard or something like that? I would be interested, and I think some folks might be asking you about that.
So, in terms of the amount I spend on this stuff, is I do a lot of tracking, but it's like, say that entering like my expenses into my budget at the end of each month, like it's got to be an activity that takes me less than 5 minutes, right? So like I want to
Wow.
spend more time on analysis than I do on like actually entering the information. if I actually had a paid subscription or like, say like you ran all your expenses through like one credit card or like a few credit cards,
Yeah.
you could actually download for free, right? But like in order to download on the budget app that I use, I would actually have to do a paid subscription, which I don't do. So like I got to figure out how can I do this efficiently, right? So like I would say probably like I could enter it in under 3 minutes. So
Wow,
like,
that's still very quick. Yeah.
and then in not just like, like that's for the monthly to feed into the Google spreadsheet, but like basically what I do is like every time I make a purchase and it helps hold me accountable, I just, if you buy something on Amazon, it goes into the budget, right? Like, like if I go buy a coffee from Tim Hortons, like it goes
Right.
into the
Right.
budget, right? So like it's just part of like that whole thing of transaction and like, like when you pay for things by tap and I've sped up the process there. So I just try to make it like, efficient there. Like I'm not exchanging cash. It would be kind of like that time saved. I would use it to like enter it into my budget app. It's generally only like where did you spend the money? How much did you spend? And like what category does it belong in? And that's like in terms of the app I use. And like I'd be surprised if it took me over like 30 seconds, like each time, right? And then it also too like makes me deliberate about like what I
Yeah.
purchase, right? Because now I got to I fit
The
it into the
category.
budget. Yeah. And I
Yeah.
got to fit it into a category, right?
And gives
And I
you
was
that
like,
visibility right on the spot, right?
yeah, and then also too, like these ones track balances as you go, which I think your credit card
Cool.
like may not actually do that. So I can see
Yeah.
kind of in real time as I'm entering the expense, like, like am I over budget in that area for like a particular month, right? And like
So the true
I've got
envelope system, right?
yeah, and I've got actually better because I have so much data now. Like I've got really like I set those buckets based on averages that I have from the past and like I can pretty much like determine like my spending for the year within about like $500 to $1,000. So like I would be very close like and I wouldn't be like that accurate in my prediction ahead of time. Like say like I would look at the food inflation report, right? That from Sylvain Charlebois out of Dalhousie University. I think this year he kind of put the inflation on food. I think he put it around like 4 or 5%. So like that would actually go into I would use that in my budget, right? So I would take kind of like, where I was last year and like maybe add some more on areas where like I do have some data, like I will try to like leverage it. But doing this like over time, I've got better at, predicting my budgets. There's like those bucket amounts.
Very cool. Very cool. I do have a few rapid fire questions for you, but before I go there, when it comes to that tracker, have you brought your partner on board as she or potentially they do the same thing? Because that's always a question. Even if I was to start, how do I kind of inspire my wife as well to do the same?
My wife would have like no interest in something like that, and that's totally fine, right? Like this is something that like I very rarely meet a person who like wants to
Yeah.
budget like I do or
Yeah.
like, wants to maintain like an exercise routine like I do. So like she wouldn't be brought on board with that. But actually like I did read a book recently, like Money for Couples. So also too like another Ramit Sethi book, which would be in like, some of the books that you've recommended in the past. Like he's one of the authors you've suggested. And like that was a little helpful just to kind of like try to understand the psychology of like somebody that's like a little bit different and like basically like how we can try to like move things like closer together. Like, do I ever think like, she would need to like track a budget like I do? I don't think so. As long as she's like more mindful of it, like, that would actually like, be helpful. Like, I try to like set it up so that like, like I put myself in the best position for success. If she did, like some of the stuff that you shared, like, when you're more on the same page, like you can just like one of the guests that you've had on before, like William Wang, he's like
Yeah.
a police officer in Saskatchewan. It seems like
Schedule.
him and his wife are on the same page and they're
Yeah.
they're really young, like they're in their like
Yeah.
early 30s.
30s. Yeah.
And I just look at that situation and I'm just like, when you have two people on the same page like that, like they're probably going to end up retiring by the time they're 40, which is actually probably like helpful for him is like I don't work like a dangerous job or anything. Like I guess the biggest risk that I would have at work is like I don't know getting carpal tunnel or something like that. Whereas like when you do like my father was like a firefighter, like he did work like a risky job. Like maybe you do want to retire like a little
Hmm.
bit earlier for
Hmm.
something like that.
Yeah, Matt, you're very well read. Obviously, you throughout the conversation you were talking about different books, mentioning it, different ones. Is there one book of all the books that you've read that one or two perhaps that stand out the most for you? And maybe if you don't mind sharing, what is the key message from there that resonated with you the most?
That's like a tough question because there's so many good ones. I'm gonna pull one from your reading list is Die with Zero. So like as you can see, like I'm by nature like more of a saver. And I found like that book was like very good in just kind of like you know, looking at like your life, like, the big picture and like, what do you want, right? And like that concept of like maximizing, the experiences in your life and using money as a tool in order to like, to attain that is what like resonated with me the most. Like I like that book was so unique that was the one that like stands out the most. And he's actually gone on to, like I mentioned that other book, Outlive, with
Yeah.
Dr. Peter Attia. Dr. Attia actually loves that book. And they actually got together on a podcast. And it
No
was like
way.
one of my favorite, health authors and one of my favorite, I guess, guys in the finance space
Yeah.
got together and had a discussion. And it was like a tremendous podcast, like in terms of if you do like Die with Zero and Bill
Yeah.
Perkins,
I'm gonna look it
check
up.
him out on the Drive podcast with like Dr. Peter Attia, because that was like an amazing interview. It was so interesting to get like, this perspective of like finance and health like together in the same thing.
That's
So,
amazing.
and then if I had to say just one other one is like Ramit Sethi, who's also on your reading list, Ramit Sethi's I Will Teach You to Be Rich. His category and budget of like, I've done like budgeting over the years, but that guilt-free spending really helped me. It's like, that way I could let go of the guilt in like spending money. So like, um, just having that category, even though like I don't name it as guilt-free in mine, it's just knowing that these are guilt-free expenses. And like, so in my budget, it would be named like miscellaneous.
Yeah.
I just have an amount in there. If I spend it, like I'm not really
No
worried what
question.
I
Yeah.
spend it on.
It's amazing. I think for many of us who are into like finances, financial freedom concept, and all of the saving and all of that, sometimes it can get tough. Like especially spending on things that enjoyable, but maybe like oh, is it the best use of time and whatnot, or is this use of time money at least? But I think yeah, that Ramit Sethi's notion of guilt-free spending really is very valuable, and I love how he coins it as well. Like spend money. Like I'm butchering it, but essentially spend money
Extravagantly
extravagantly, yes, on the things
on
that
things
matter
that
to
you
you.
love
Yeah,
and
exactly.
cut
Like things that
mercilessly on the things that don't.
exactly. Oh yeah, you nailed it exactly. So it's simple yet so powerful. Because at the end of the day, it goes back to I guess your notion of why you're tracking because you're trying to be intentional about it, right? Okay, is that when you reflect back, is that the area that I wanted to spend money on? If not, if it doesn't align with my values or things that matter to me, maybe I need to rethink it. Maybe I need to be mindful of that for sure. Those are great books. I'm definitely gonna check out that episode that you mentioned between the two favorite authors of mine for sure. And the second one, to be honest with you, I've put a hold on the book Outlive from the library, but I think I'm like probably on the 100th person on the waiting list. I think at some point I should probably go ahead and just buy the book or try to find it somehow.
Actually, you mentioned that there, and this actually comes up from Ramit's concept from Ramit is like, like the expense extravagantly on the things that matter to you. And I
Yeah,
was like, I thought it was interesting when you said like you were waiting for the
yeah,
book at the library, because that's what I used to do. I used to get these books from the library. But Ramit like helped me in terms of like, what are the things that I like in life? And like one of them is books, right? So like I put no cap on my budget for books. Like if I want a book, I just go buy it. And then how I find that helpful too is like, say like we were in closer proximity, is I loan out my books, right? Because like, how we get in this discussion on books, it's like, like if you were closer, I would be like, okay, I'll just come drop that book off
yeah,
to you and you can read it whenever you want and return it
yeah,
to me whenever you want.
yeah.
So like sometimes like I especially too with some younger people at work, like I feel that some books, some podcast materials, like I've sent some of your stuff out before. So I share that. And I do kind of like when I go into work, if I think somebody will benefit from a book, and, they express interest in reading it, like when I mention it, I just go and hand it to
You
them.
want to head out to them? That's really cool. And I mean, it's a great point that you bring up, Matt. I guess one of the hesitations that I've had, obviously, money was one for sure, and still probably is. But I think with money, I've started to loosen up a little bit more. Like I notice now, like when I go out, let's say for dinner or something like that, or food with my wife and my daughter, I've started actually changing my mindset. Before it was like always like about looking at the menu and trying to be very mindful of, oh, are we gonna get this one or like $5 more? And now it's more like really enjoying it as opposed to I guess probably one of the reasons for that I've recently started picking up this book. I'm still in the second chapter only right now. It's called The Wealth Ladder. Really interesting because it talks about essentially based on how much your net worth is, you're already in a different type of, based on where you are, in different type of mindset. Your mindset should also evolve. So it's really a
Mm.
great reminder. All of that to say, one of the reasons I was not really getting books, because I at least believed in my head that, like, I'm not much of a hard copy book reader,
Mm.
and every time I buy a book or get a book, it sits there and collects dust. But as I mentioned, this book that I borrowed, The Wealth Ladder, so far I've been really enjoying it. So it might really trigger that thought. But I think Outlive is definitely the one that I'm gonna probably buy, because I think it's also being intentional in my mind as well. Like, that's an area that I want to focus on. And by having the book, it also shows and probably trains your brain as well, like, around the importance of it. It's not something like it's just a second thought, wait for it when it becomes available, but rather being intentional, especially being in the almost the beginning of the year. I think that's a good
Mhm.
timing for that, for sure. Thanks for sharing those books with me. I do have a few quick rapid fire questions, if I may
Yeah, no
ask
problem.
you those ones, and as well a quick surprise question at the end from one of my other guests. All right, so moving on to the rapid fire questions. It's going to be quick, so don't overthink them. First one, in terms of preference, ETFs or individual stocks?
ETFs.
Okay, spreadsheets or apps?
Ooh, that's a tough one. I'm gonna go with apps just for like the ease of use. You don't always have your computer on you, but like an app, you would always have your phone with you. And I do more of my data tracking in apps than I would on a spreadsheet. Spreadsheets are more for the roll up. So
Yeah,
apps
apps. Best financial habit you've built this year in 2025?
this year, I'd say like overall would be the pay yourself first. We'll kind of say that best financial habit in 2025 is the setting a certain percentage for savings rate
Mm.
in line with the pay yourself first.
Great, great one. One financial goal you're most excited about for next year?
I'm interested in trying that passive income one. So,
Yes.
not that I am by any means a dividend investor.
Yeah.
I just want to see if I could do it because it just the implications of it for like when I retire, right? So just keeping my income consistent. And then like in theory, like I would never even touch my portfolio, right? And like maintaining my income. But like, yeah, I guess that like passive income, but like I will continue to be about as good as a dividend investor as
Yeah.
you are.
Yeah, that's amazing. And Matt, on that note, I don't know if you saw some of the posts. Carr was the one that at least I saw him
Mm.
first talking about it, the ZGRO-T. So it's almost like a ZGRO, which is like a all-in-one, but it's 80% stocks, 20%
Mm.
bonds. But the T series one, apparently they have these monthly payouts, and they bumped it up a little bit, but still it's relatively healthy range of, I think, around 5.5% to 6%. It was interesting one. If so much so that I actually was talking to my mom and I encouraged her. I was like, hey, you know what? Given that you're already retired and you maybe if you have some savings, maybe that's something that you could consider. And she's been loving it for so far. But I heard recently, I can't remember, was it? It was not probably Card. Somebody else on Blossom Community, which is an amazing one, was talking about BMO is coming up with the ZEQT. The ZEQT series of it as well, which is again similarly pays a 5 to 6% yield annualized, but pays it on a monthly basis. All of that to say is that for now, I'm in the XCQT cam and all of that, but I wouldn't be shocked if, let's say, as I get a little bit of closer to potentially retirement or early retirement, consider something like that. Because at the end of the day, I know at the end of the day, it's semantics. You could also sell your shares and whatnot, but I guess there's something psychologically with a little bit of that dividend or something like that coming, even if it comes off of the value of the price of the shares. It's something nice about it. I guess that's how I think.
Yeah, no, like those would be interesting. There's also too, like if you listen to the Rational Reminder, like Ben Felix was talking about, I think it was CIBC coming out with a like one of those like dimensional funds,
Is
which
that
is
the
like that's what
Avantis or something like that?
yeah, that's what like he was talking and like that product kind of like piqued my interest too. Is that's the one where they
Interesting.
kind of like do some weighting in terms of some like, some small
Sectors.
caps, some like, some sectors that are like having some growth and stuff like that. So that was one product that was mentioned or like, more recently that that's what he invests in. I guess
Yeah.
assuming that those weren't available to him, like he kind of like he likes the VQTs, XEQTs, like ZEQTs, like any of those products. But that was one of the things that like the announcements. So I thought I was like, oh, that's going to be interesting, something worth checking out as well.
It's amazing. Like, I'm so glad that these days more and more options like that are being provided, and a lot of them also at much lower cost compared to like a traditional mutual fund and whatnot. What's funny, also, I was reading on Blossom, I think, a very fascinating post. I think it was, the name is just skipping me, but one of the amazing folks that I actually follow on there, they talk about, like, how sometimes, we get out of that whole high fee mutual fund investing, and then somehow, almost from the lack of better term, may already be tilted now towards some of the other high fee products, even though we are self choosing to go in there. So I guess, not trying to bash any of those products, but it's just being mindful of that, not coming from one aspect and totally falling into the another, not calling it trap, but, like, in another area that, you need to be mindful about.
Yeah, keeping those fees down is like so important, right? Like it's one of those things like when you look at any of those like compound interest calculators, when you put kind of like with and without fees, it's like literally like hundreds of thousands of dollars, right? And it's like if someone's going to do hundreds of thousands of dollars of work for you, like, you'd want to be able to show something that's like, really profound, right? And in most cases, like that's not it, right? Ben Felix speaks to like it's a very, in other books as well, like a very small group of people. Like they talk about like that upper decile, like 10% can like outperform the index consistently, right? And like 90% can. And these are professional money managers like with less fees. So like those fees, like if you're going to be paying those fees, like the expectation is very high.
Yeah, 100%. The fees is coming off of it as well. So, you, like, to your point, like, the chances of them succeeding is gonna be really, really tough, because not only they have to outperform the market, but they have to outperform it by at least those fees and or
Yeah.
even more, to be able to make that happen.
And when you talk about like stacking probabilities in your favor,
Yeah,
that is
it's
not
getting
like,
tougher
we were
and tougher.
talking about lump sum versus DCA,
Yeah,
which is like a 60/40. When you get into like the 90/10, it's like, yeah, like I really don't feel that I'm going to be on the 10% side. I was like, I'm probably going to land on the 90% side. And if so, like, let's try to reduce the fees as much as
yeah,
possible.
it makes sense. Makes sense. Coffee or tea?
Coffee. I drink like multiple coffees every day. It's like that's the one thing I love on my diet. I actually go to because I work from home. I actually go to Tim Hortons every day and pick up a coffee
Nice.
just so I feel like I get out of the house. And it's just part of my routine. And I started doing that when I paid off my mortgage. That was like, people talk about I want to take this trip, I want to go on these luxuries. For me, it was just getting like getting a coffee each morning is kind of like I get it and it makes me happy. And like it's been years of doing it and it still makes me happy.
That's amazing. Like, the joy that comes with it. That's the most important thing. Yeah, I could go in a tangent here, or I won't. But on this, the paying off your mortgage, was there at all, at any point, a little bit of that, like, thought process in my mind that, like, oh, rather than, like, expediting and paying my mortgage faster, maybe I invest, and because I know it's a good old dilemma of a lot of folks that can happen, right? Like, should I invest? Should I pay down my mortgage? How did you make peace with that at the end of the day?
So I feel this is one of the areas like I've made many mistakes and that's one of the ones like in terms of like optimization, would that be the optimal thing to do? And like I think the answer is pretty consistently no if you were to follow the data. Although Morgan Housel from Psychology of Money and Dave Chilton, the wealthy barber, were talking about it on one of their podcasts recently, and he's like, try to find a person with a paid for house that like is upset about the decision, right?
Yes,
So
yes, yes,
like
yeah.
they did mention that, and it's like it is by no means like optimal paying off like low interest debt. However, it was just like one of those goals that I set. And I think it had to do with like there's some psychology behind it is I moved around a lot. And like you hear about The Rock, like when he talks about like his The Rock, like the wrestler and the movie star, he has his like $7 Productions as his like movie company. And that $7 like relates to him is when he was cut from the Canadian Football League and like he basically had no job and he had $7 in his pocket, right? So like I figure like when I started out, I wish I would have took like a snapshot of my balance. Like it probably would be somewhere close to that. Like when I started working, like maybe it might have been a few $100, I don't know. But it was like one of these things and it was like, just always like as a student like struggling to pay my rent and like I always paid my rent, but it was like one of those things that I always found like difficult. And I just, I wanted to kind of like have a house. So like, I wouldn't have to worry about that anymore. And then also to like, so I wouldn't have to move around anymore. So, lived in like over a dozen places, like lots of different roommates and things. I was like, oh, I just kind of like want my own place. And that's what it was rooted in. And it was just like, okay, like I want to be mortgage free by age 40. And like that was my goal. And like that's one of those things that you can do pretty easily on a spreadsheet, because like if you know the rate, or like roughly the rate and the amount, you can just kind of say, well, what do I have to do until 40 to do that? Optimal? No, but like it has created some freedom in my life now. However, so my kids and like some of the younger coworkers at work, I would not like recommend it like these days. And that's
Would you?
where everyone who like a
Yeah.
recent homeowner gets your Smith maneuver video. So I always
Yeah.
share the Smith maneuver video, and like any like new parent gets your RESP video.
Yes, yeah, I appreciate that. No, thank you. Yeah, and to your point, like, yeah, sometimes I listened to that episode of the Velocity Barber with Morgan Housel. It's amazing. He was talking about that as well, how he also brought it up as well. Like, it's also boils down to the decision that he didn't, I think, categorize even as being false. To your point, maybe not optimized, but to him, it was a decision that he valued. And who is to say that that's a wrong decision? Like,
Hmm.
he sleeps comfortably at night, and multiple, I think, decisions like that. He was talking about as well, like, how he was keeping of a much larger, I think, like not investing in the stock market as much, or maybe keeping a much larger emergency fund and whatnot. And that's totally okay. Individual preferences are so different. Matt, I do have one surprise question as my final one, and this one was one of my previous guests. This is the question: the S&P 500 index was around 1,000 points about 20 years ago. Today, it's pushing towards 7,000. Where do you think the S&P 500 is 20 years from now? In other words, they said in the year 2045. And also, how much of that is real growth versus inflation and monetary expansion?
So that's a tough question, and this is
Mhm.
just pure speculation. Just
Yeah.
to throw in, so like we'll use a nice round number, 20,000.
Yeah.
Like, so there's always going to be like the inflation component of it. Like, as you can see, like I track inflation of my budget. Like every time that CPI report comes out, both American and Canadian. I haven't done the math in order to get to get to that 20,000 point. Like, yeah, like it seems like when you average it out historically, like they're kind of in and around that like Bank of Canada like key rate, like, or that, sorry, that 2 to 3% that their target. So like, yeah, like I would say most of it is going to be off of the, like growth of the companies and an expansion in like the profits of those companies versus like inflation, right? So
That's
especially
awesome.
too, we're kind of in a unique time right now with, like there's been all these like historical things like railroads kind of like
Mhm.
change things, computers change things, the internet change things. And like now we're kind of in one of those stages where like artificial intelligence is kind of like changing things, right? And it's probably going to move the needle forward.
A blockbuster.
So
Yeah.
significantly higher than where it like it's going to grow more in the next 20 years than it did in the past 20 years.
Yeah, it's amazing. Like the pace that technology is evolving is just incredible. I think that's a fantastic response. We're gonna hold you to it in the year 2045. We're gonna see how it is now. All the jokes aside, I think that's one fun aspect of the podcast that I've tried to introduce. Really having a question, and really, there's no right or wrong answer. It's really a lot at the end of the day about your perspectives. Matt, it's been so wonderful having you here today. I really appreciate you accepting my invite, coming on the show, being so generous to share your dashboards with us, which I'm sure, as much as it's been inspiring to me, is going to inspire so many other folks as well to try to be serious about their life in terms of their savings, their finances, their health. Because at the end of the day, keeping track of these aspects, it's a good reminder. Like, you're not just in today's day-to-day grind, but rather being intentional about it and having visibility towards those things. So thank you so much for all of that. I really appreciate you coming on the show.
Well, thank you so much for having me. Like I'm a huge fan of of the channel, as well as your content on Blossom, to the point where like it's like really like had some positive impact on my life in terms of like, like those books that you recommend, like I pretty much read them all. I've actually made the switch. Like, how you had a post on switching from Wealth Simple to Quest Trade?
Yeah.
And,
Yeah.
and the post was basically like, it's going to be thousands of dollars for me. And I was kind of like happy where I was. And I was like, well, you kind of said that. And I started looking into the numbers and doing the analysis on it. And I actually switched over to Wealth Simple.
No
I looked
way.
at them
Yeah.
both, and like Wealth
Yeah.
Simple made the change. My kids are like XEQT investors. So
Yeah.
like, and I think like I got the concept like originally from you, and also too like you did introduce me to like these dashboards that you see. I never even knew Google Looker Studio existed until like you mentioned it to me. So
Oh,
like
that's amazing. amazing.
Again, I'm a huge fan. Thanks, like you've had such a like positive effect on just like my investment journey, as well as like all these other things like the reading, like helping my kids and stuff like that. And like I'm going to continue to watch the channel and be a fan. And thank you so much for having me on.
Oh, it's my pleasure. Thank you so much. And definitely means a lot to me and super happy to hear that, Matt.